What's going on, everybody? It's Brian Trippe. Welcome to a bonus episode of the REI Live podcast. I interview the very best real estate investors, entrepreneurs, and business leaders all throughout the country. I just did a podcast episode with my good friend, Mr. Jeff Stevens, who's with me today. How's it going, Jeff?
Hey, it's going fantastic. How are you?
I'm doing great. I'm glad you were able to jump back on because we did a podcast, I guess it's been a month or so ago now that it came out. And we talked a lot about kind of like higher level, kind of 30,000 foot overview type of things, but didn't really get into the deep, granular stuff of real estate and creative deal structure. So I wanted to have you back on to talk about a deal you did recently. I had the pleasure of hearing from you at an event that we were at in Las Vegas through our mutual friend, Greg Pinio. And heard you tell this story, and it was just an incredible story of how you were able to acquire this property. And I want you to kind of talk about that in particular. So I'm going to kind of turn it over to you and let you kind of tell the story of kind of who you are and what you did specifically with this deal. And I'll probably ask you some follow-up from then on. How's that sound?
Sounds perfect.
Awesome. Let's hear the story. It's incredible.
Yeah, thank you. It's definitely one of the more epic experiences I've been through as a real estate entrepreneur. And it took a lot of kind of persistence and ongoing strategy. This whole story that I'll tell you in the course of 15 minutes or so here was actually about an 18-month story overall. And so what we're going to talk about is a kind of a small commercial building. It's about 7,000 square feet above ground in a classic neighborhood in Portland. It's an old building, built in 1907, really beautiful brick building. And it was originally built as the Bank of Sellwood. And Sellwood is this little neighborhood in Portland. And a very interesting thing happened about a few years after they built this building. For some reason, who knows why, a lot line was drawn through the building. And it separated the building into about a 40%, 60% split. And as I would find out later, the two sides of the building had been owned by separate parties for over 100 years. So my part of the story actually starts when I did a mailing. So I'm big into mailing to lists of properties that I'd like to buy. And in Portland, we've had a lot of attention in the last couple of years about the probability or the likelihood or potential anyway of earthquakes. And so that has put a lot of focus on what about buildings that aren't really earthquake engineered, right? Old buildings. So something called unreinforced masonry, like concrete blocks or brick, like this building. And there are about 2,000 buildings in the city that were identified on a very specific list that you could download right off the city's website of these buildings. And so I thought to myself, obviously if I was going to buy one of these buildings, I too would inherit the challenge of needing to update these buildings. But this is definitely a list of people who might be feeling like they don't want to own these buildings any longer. So I thought, well, that's a group of people who might be more likely to return my call. So I sent a mailing out to these particular people in this niche list. And it wasn't too long before I got a phone call from the owners of the smaller end of this building. And they called me, and of course I looked it up in my list, and I just said, oh my gosh, this is a gorgeous, gorgeous building. And I went to talk to them, and we pretty quickly agreed to a deal. And this side of the building was going to be $900,000. I was going to have a financing contingency, some inspection contingencies. And so I immediately thought to myself, I'm going to keep this to myself, but I'm going to go see if I can reach out to the people on the other end of the building too, because certainly it would be better to own the whole thing than just 40% of it. And I reached out to the other people, and they were not interested in selling at that moment. We actually established a nice little connection, but they weren't interested in selling at that moment. So I thought, well, okay, if I proceed though and I buy the 40% end of the building, then I'm certainly well positioned to be the person who gets the opportunity to buy the other side whenever the time comes. And so I proceeded to do my due diligence, and I thought, boy, it's going to be a little more work than I thought. The whole unreinforced masonry seismic updating thing that the city may actually mandate happens in the future was a very gray topic to me. It's a major wild card. We didn't know if they were going to make us, put $10,000 worth of strapping on the building or $500,000 worth of bracing. I'm not an engineer. I don't know these things really. So that seemed kind of scary. And ultimately, I tried to negotiate the price, and the sellers were willing to negotiate with me, but not quite to the point where I felt comfortable. So unfortunately, I had to terminate the transaction. And I thought to myself, dang it, this took 6 months to get to this point, and such a beautiful, rare building, and I had to let it go. Well, a few months later, I received an email from a friend, which is a forwarded listing from a commercial broker. And he says, hey, isn't this the building that you had in contract previously? And so I said, yes, it is. And I called those brokers and I said, guys, I used to have this building in contract. I'd still love to buy it. I'd love to take another run at it. I wouldn't need to do due diligence again, so I could make kind of an interestingly attractive offer. I still do need to get my financing together, but would the sellers accept it? And they went and asked, and ultimately the sellers said yes, but the sellers said, hey, we've spun our wheels with you before, and so it's going to take some hard earnest money. So I put about $15,000 of hard earnest money into that.
Hard earnest money meaning non-refundable.
Non-refundable, really no contingencies whatsoever. So it wasn't coming back to me.
That's scary, right?
It was scary. It's not typically how I do business at all. So then I went to the people at the other end of the building though. Actually, right before I wrote the hard earnest money check and deposited it, I went to the other end of the building people and I said, hey, I know you weren't ready to sell a few months ago, but I would really like to be the guy to buy this building from you. And they said, well, okay, we might be a little more open to it now. So now, Brian, I was really deliberate not to tell the people on the first side, right, the smaller side, that I was going to talk to the people with the bigger side, because I knew that if they knew that I was going to be successful buying the other end of the building, that all my leverage with them in any type of negotiation would go down the tubes, because they would know that I needed them to continue to play ball with me, basically. So I tried to keep my two separate negotiations as separate from each other as possible, because I just didn't want to lose any of the power of any of the cards maybe I had to play, right? If I was threatening to back out on one transaction, the other, they would call my bluff, because they knew, hey, no, you're proceeding with the other side. This is all just a negotiation tactic. Right. So the long and the short of it is that I just had to keep following up with both of these parties. And ultimately then, after about 12 months, I did have both sides of the building in contract, completely separate, unrelated negotiations. Now the question was, how in the world am I going to get these things closed? Because, I know numbers are all relative to your market, but these were big numbers for me. I was overall paying $2.14 million for this building in two different transactions. And in my world, that's a pretty big deal, actually. And so I had to figure out how I was going to put the money together. And the way that I ended up doing it was completely two separate financing strategies for the south end of the building and the north end of the building. And so it was quite an epic battle. But the long and the short of it is I did end up closing the first side of the building in November of 2018. And then the second side of the building in February of this year, 2019. And I became then the first person to own this whole building in 101 years.
So I want to talk about, I want to ask you three specific things, three specific questions. And then we're going to get, for the guys that are like, you just glossed over the entire financing. You said the two strategies. I definitely am going to ask you about that. We're going to get to that in a second. But first, I want to ask about the list, because I think there's probably a lot of single family people who are listening to this. I know that you I know that you've done single family. And I think if we're doing marketing, we've heard, we need to get lists. A lot of us maybe have heard absentee owner. We've heard some of these like basic lists that most people go and get, right? You just thought that it would be a great list to send to. You just read about it. And I'm sure there are niche lists like this in every market. Just talk about going after something more niche where maybe the competition is not as fierce.
Yeah. To me, this list was a list of people who might not even know that there was some stuff coming down the pike towards them that could make their life as building owners difficult. I couldn't be guaranteed that all these people even knew that their building was on this unreinforced masonry list, but I knew that they soon would be getting communications from the city about that, and they'd start to catch wind of maybe what some of the implications of that would mean. And, generally speaking, no big surprise here, the owners of these unreinforced masonry buildings were not terribly excited about being told by the city what they would have to do to their building on what timeline. And so it created a big hubbub, of course, in our town. So I almost felt like it's almost like I could see that this storm was coming. And even if the people sitting exactly where the storm was about to hit didn't know they were sitting there, I knew they were sitting there. And if my letter landed in their mailbox at a moment that they were starting to realize that, or maybe they held on to the letter for a few weeks and then they started to realize what was going on, that would be, it's sort of a motivated seller's list in a different way than maybe we usually use that term. But it's a group of people who are about to undergo some major change. And that, to me, change makes things move. It makes things loosen up. It makes conversations maybe more possible.
Yeah. Can you give people listening an idea of what that letter might have said?
Yeah. So actually, it was very much like my normal letter. I was very careful not to say anything about it being an unreinforced masonry building. I didn't say, hey, by the way, you own this unreinforced masonry building and you are about to be hosed. I just played it way more casual than that. I said, I'm a local entrepreneur. I have other rental properties. I came across your building. It's so beautiful. I'd love to if you would entertain the conversation with me, I'd love to speak with you about it. So I didn't really let on in my letter at all about why. And I'll tell you, actually, as I fast forward in my mind to those negotiations I had separately to buy the two parts of this building, which, by the way, I'm sitting in right now. It was important that they didn't feel like I had reached out to them because it was an unreinforced masonry building. That was like a card in my deck, but I kept that card in my hand until we got into the due diligence process. Then I came back and I said, did you know that your building is on this unreinforced masonry list? And of course, then whether they knew or not, they didn't really let on to that either. But my point is that the strategy of the list wasn't really just about sending the letter. It actually was relevant even into the negotiation throughout the due diligence period.
Yeah, I think there's a couple things there. First of all, even, I think of like foreclosure, probate, things like that. We never mention, hey, by the way, we realize you're in foreclosure right now. We don't mention that. But that is a card that we can keep, that we could possibly play later. So I think that is important in negotiations. But then the other thing that you said, and I just drew a blank, but there was another thing you said in there that I thought was very important too, about just lists in general, niche lists, going after this. Oh my gosh, I should have wrote it down, like taking furious notes. But there are a lot of important things that you need to think about when sending a list. Competition is one of them. Is a probate list that in our county is very difficult to get. So are you going after these lists that are difficult to get, or are you going after lists that everyone has access to that you can just get on a list company, list source or something like that? So I think that's great. So lists are huge. Now, Jeff, I want you to talk about the follow-up, because you just got done saying that it took 18 months from first contact. That's a lot of follow-up.
Yeah, it took a lot of follow-up, a lot of persistence. And of course, at the time, I didn't know it was going to take that long. But in hindsight, now that I think back on it, this whole unreinforced masonry situation in the city of Portland, it was a moving target. And so in hindsight, it actually makes sense to me that we didn't really know how it was unfolding on what timeline. So it kind of makes sense to me that it ended up taking a long time. But I had to be really persistent with both people on the ends of the building. Like, there's a big part of me that when I saw the south end of this building come on the market with commercial brokers, there was a voice in my head saying, Jeff, don't waste your time following up with them. They're just going to say no. Like, just save yourself the time and the embarrassment. But I'm obviously really glad I didn't do that, because that follow-up, even through a different channel, ended up getting a yes. Yeah. And I knew also, this whole setup of one physical building having two ownerships, and we're not talking about condominiums, we're two ends of the building, is really weird. And I knew that actually that would make the broker's job more difficult. So I'm really glad that I stuck with that there too. But then I went to the other end of the building, and I had gotten a flat out no from those people the first time. But I was really careful not to, burn any bridges or anything like that with them. I was really careful to have them feeling good about me. And so as I continued to follow up, it was more like a polite persistence and follow up that they didn't find annoying. They found it, I think, sincere and maybe even admirable. Like, hey, this guy knows what he wants. He's politely following up with us. And, all it takes in this case is the two yeses that when the stars aligned with two yeses, that's what I needed.
Yeah. And so, by the way, guys, this was like an hour-long presentation that Jeff did when I saw him in Vegas talk about this. So we're giving you definitely the Cliff's Notes version here. But Jeff, I do want you to talk about the financing piece, because I think that's important. You mentioned that, $2+ million acquisition is a big deal for you. I think for most people listening to this, that's a pretty large transaction, especially you're in Portland. I'm in Birmingham. Like, these transactions that building would probably be a quarter of what it's worth, maybe half, at least half of what it's worth, here, if it were here in Birmingham. So that is a large transaction in my eyes. So how did you creatively put this transaction together when it comes to the finances?
Okay. So it's really two totally separate stories, because there's two separate transactions and closing timelines. The first side of things, I ultimately was buying the building. We negotiated to $840,000. That's where I was. And so I had to find the financing for this. And I just want to point out too, that when you go to a bank might not be excited about it being unreinforced masonry anyway. It might be not excited about the fact that the bank knows that there's volatility in that space in the city of Portland too. So it wasn't making conventional financing any easier either. So I actually set myself up for financing success in this through something that I did at least a full year earlier. Now, as I recall our previous interview, I think I alluded to some of these little tactics. And this is stuff, you mentioned Greg Pinio before. This is the stuff that I've learned from him as my mentor. So a year before, I had bought a 5-unit small apartment building. And I bought that building with seller financing. And it had a nice big note. Actually, I paid $830,000 for it. So it was almost exactly the same purchase price as this first end of the commercial building. And that beneficiary of that promissory note, the previous owner of the property, they and I had agreed that they did not want to be paid off early. We had a 10-year note, and they did not want to be paid off early. And that's mostly for two reasons. One is they wanted to continue to have an income stream guaranteed, and they did not want to get a big capital gains tax bill. That's actually why we had structured this transaction, my purchase of their small apartment building, with a note in trust deed in the first place. Okay, so I knew also that particular property, in the grand scheme of my portfolio, was expendable. It was a pawn, to use a chess metaphor. Like, I was willing to sacrifice it to buy a queen or a king or something. And so what I did there is I put that 5-plex up for sale. And when I got an accepted offer, as we got closer to closing, I went to the beneficiary and I said, okay, I am going to provide you a different piece of collateral for this note. I want to give you, I think it's a better piece of collateral. We've already agreed that I have the ability to change the collateral for you on this promissory note, which is at the time $720,000. And they said, sure, of course, that's fine. So mechanically what happened was the buyers of my 5-plex, they were buying this. This was a great win in of itself. I bought this thing for $830,000 and 12 months later sold it for $1,125,000. So it was a good win on a flip anyway. But aside from that, the biggest win was actually this financing play. So my buyer's new money comes in of $1,125,000, and my seller, or my beneficiary, does not require me to pay off this previous note. I have to move it. I have to move the deed of trust to another property instead. So effectively, I use the buyer's money. This is not a 1031 exchange either. I use the buyer's money from my 5-plex to come in, and it really provides the financing for the first part of my commercial building, and the deed of trust associated with that 5-plex got re-collateralized with the commercial building. Now, I know that's not real estate finance 101. I hope that some of the basics of that make a little bit of sense. But the point, if I could have everybody take away one point on this, 2 points I'm going to say. One is the value of the financing you negotiate is an unbelievably important thing, not just for that deal, but for, depending on how you do it, potentially for future deals down the road. That's point number one. And point number two is that I set myself up for success a full year earlier, before I ever knew this commercial building existed, by negotiating that financing well.
So, and you have to remind me, Greg Pinio is saying, I think it's incredible if I can ever remember it, about how real estate and the clothing is financing is the clothing real estate. Where is that? Is that the same?
Yep, exactly. Yep. Or it's real estate is the clothing that finance wears. Under it all, it's really all about financing. It manifests itself as real estate, sticks and bricks and dirt. But at the end of the day, it's really about financial structuring.
And I've also heard, and I'm sure Greg said it too, but I've heard, a lot of, or some people recently talk about how, there's a lot of folks out there looking for wholesale deals. We're looking for property at wholesale pricing. And a lot of folks, including a lot of sellers right now, retail sellers, are only looking at purchase price. Like the purchase price is the most important thing to me. And we always think about, we want to get wholesale pricing, but we never think about getting wholesale financing. What if you could get financing at a wholesale price at a really extremely low interest rate with, clauses in it like substitution of collateral, which is what one of the clauses you had in your financing piece there. Like, how can we get our financing to be wholesale type of financing? And I think this is an incredible lesson in that. So
it is,
that's the first story. What about the story to close on the second part of the building?
Well, that story is much less heroic and exciting.
Okay.
That side was one where I went down several different paths evaluating things simultaneously. I went to a bank. I went to private individuals. It was challenging. The NOI in this building is not that great, really. And so I was definitely paying a full market price. Now, a bank in that case also that's looking at this one portion of the building is not taking into consideration the fact that I am buying the south end of the building too, that there's a synergistic effect of a 1 + 1 = 3 here, that it's really kind of an odd thing to buy one part of a building. But so their valuation of this building did not really reflect that my unification of the two pieces was creating a lot of value. So it was difficult. And ultimately what I ended up doing was going to effectively kind of a commercial hard money lender to put some short-ish term, private financing on the property, just simply to get it closed. So that was not, really my plan A. But now what I'm doing, right now, like literally today, I've got phone calls regarding then refinancing this whole building.
Right.
As one, right? Because then we can sort of capture the value that we've created by unifying the building. I've improved the NOI in the last few months. And so it's a better, more lendable product right now. Yeah. But just to connect something here real fast. If I go and refinance this whole building, we're back to my $720,000 note. That person doesn't want to be paid off. I don't really want them to be paid off. So now I'm looking to do the same thing somewhere else. Where else could I move that amazing block of financing? This is $720,000 at 4% interest only. I don't want to pay that off. That's awesome. Yeah. I want to keep it moving productively into my portfolio moving forward.
So if you were to get financing on the whole thing, you, as almost like a contingency to this, you would want to have identified another property where you could move the 700 and something thousand, move that over to another property so you don't lose that financing.
Exactly.
That's awesome.
And this is what I do. This is what I do all the time. Just last week on a totally different property, a 4-plex, I accepted an offer and we got through the contingency period. Contingencies have been removed. And so the money's coming my way, but there's $500,000 there of notes that don't need to be paid off. And those people don't want to be paid off. So this week, my project is to kind of look at my portfolio and say, where else could I put this financing? Because I don't want to lose it. And so that's kind of a part of the game for me, the way that I do things.
Yeah. This is almost where like real estate gets really fun, right? At least it seems fun to me.
Yes. It's it's like sometimes Greg and I talk about it in our coaching calls as like three-dimensional chess. Like it's a chess match. It's very strategic, but there's different dimensions. It's not just
Right.
It's complicated, but it's such intellectually engaging challenge. I love it.
That's awesome. Jeff,
Yeah.
wrap all this up for us and give us kind of like the conclusion. You said you're sitting in the building right now. Tell us what you've done. I think it's incredible what you have done. So tell everybody what you've done with this building now.
Yeah, thanks. So one of the things that we've done with the building is there were a couple of vacancies when we bought it, a couple of things that were coming vacant right after we bought the two parts of it. So we have sort of, re-tenanted and filled some of those vacancies. But the corner, the kind of the anchor unit in the whole building is it's 1,400 square feet on the main floor, another 900 in the basement, which is where I'm at now. It's the most prominent part of the building, and right before I closed on the second part of this building, I got wind that this tenant, which is the biggest tenant in the building, especially of this part of the building, was likely going to be breaking their commercial lease, moving out 2 years early.
Wow.
And with me holding the bag with a 10% commercial hard money note, not ideal. So we had to have a plan quickly to replace that income. And so we started looking around at just replacing it with another retail tenant. And we had some good prospects there. But then I had an idea, because I knowing that someday soon I'm going to have to do a major seismic retrofit on this building, I don't really want to do a bunch of ticky-tack little tenant improvements right now. I'm kind of worried, honestly, that it could create a domino effect of things that could just, the next thing I know, I'm doing major work sooner than I want to be doing it. So I asked myself the question, what could we do that would require very little tenant improvements, that would be flexible and versatile? I wouldn't be stuck with a 10-year commercial lease if I decide I want to do these improvements in 5 years, for instance, something like that. And so the answer I came up with was to use the space as a co-working space, kind of like a local neighborhood version of a WeWork type of a thing. Excuse me. So for about $20,000 total, we were able to just kind of cosmetically resurface this unit. So paint, carpet, and whatnot. My contractor built some modular room dividers, basically, that we have then we've kind of made, I hate to use the word cubicle because it sounds very corporate, and that is the absolute opposite of this vibe, but it's sort of like cubicle spaces. And then we bought some desks and furniture, and we're now renting out this whole space as a shared working environment. So there's you can rent a cubicle for $500-ish a month. You can just have a desk where you pop in and out whenever you want. You take your stuff with you. I'm sitting in our community conference room right now, so you got reservable conference room time. This is a bank after all, so right behind me, actually, on the other side of this wall is the original vault with the original vault door. So we've opened that up, and it's now a sitting room, so you can go in there and brainstorm or have a small meeting or just sit and read or whatever you want to do. So it was a really fun way to create something that was kind of lacking in this neighborhood, something really unique. From a real estate business model perspective, now instead of one tenant paying, $4,000, I've got 15 tenants paying $5,000, and it just diversifies the income stream, and it's awesome so far.
I think it's awesome. I think it's incredible what you've been able to do. And I appreciate you sharing the story with us, because I think that it's valuable. I think to hear people's stories and to kind of maybe get some people's creative juices flowing, and that real estate is not just like go buy, fix, sell, repeat, rinse, repeat. It doesn't have to be that way. You can do so many creative, incredible things just like you've done here. So Jeff, I appreciate you, man. I appreciate you sharing that story.
Oh, I'm glad to share it. Like any good deal, it was a great deal, but it was an incredible experience of learning too. And so if I get a chance to relay some of those lessons, everybody should win.
Yeah. And I know we did this on our last podcast together, but tell everybody how they can get a hold of you. I know you've got an awesome podcast that I happen to be a guest on, and you have an incredible Facebook group too. So tell us about that.
Yeah, thank you very much for offering that. What I do is I call this the Thoughtful Real Estate Entrepreneur. We have a Facebook group called Real Estate Investing for Thoughtful Real Estate Entrepreneurs. So come check us out there. And in there, it's not like we're posting deals and this is for sale and this and that. We're kind of strategizing situations, and we're kind of talking about this sort of school of thought that I like to be an advocate for. And my podcast is called Sleaze-Free Real Estate Investing. And it's the common denominator at the end of this, and I would say even the common denominator in this story, whether I did a good job of making this point or not, is all of this was about people. It was about me being face-to-face, literally in their living rooms, trying to work out things that worked well for everybody. And that's kind of my overall approach. So in the group, the Facebook group, that's sort of what we talk about. In the podcast, that's what we talk about. And that's sort of my platform.
Yeah. Well, I love it. I mean, it's hard to think of something more thoughtful than the deal that you put together. So it's really awesome. And thanks again for sharing that. Appreciate it, Jeff.
Thank you, Brian.
Guys, we love you. Make sure you hit subscribe. Got some incredible stuff on the horizon. We love you so much. We're going to see you very soon. See ya.